Are you a real estate investor looking to elevate your income, freedom, and lifestyle? If so, optimize your daily performance by downloading our free guide, Raising the Bar, 5 Steps to Elevate Your Habits at elevatepod.com. In this guide, created by yours truly, you'll learn why you do what you do, how to easily institute cues in your environment to trigger desired behavior, directly applicable steps to create a fulfilling future, and much more. Get your free copy now at elevatepod.com and kickstart your new habits today. Your future self will thank you.
Welcome to Elevate, the masterclass where we dissect the elements of exceptional achievement and lifestyle design with a focus on personal growth and real estate investing. Now, here's your host, Tyler Chesser.
Elevate Nation, welcome back. This is Tyler Chesser. I'm so thankful to have you here, and I am blessed and grateful to be sitting with Jake Clopton today. Today, you're going to make sense of the macroeconomic crosswinds that we are dealing with and how that relates to greater success in commercial real estate investing, whether you're investing in multifamily, self-storage, mobile home parks, retail, office, industrial, you name it, whatever asset class you focus on, or maybe you're focusing on residential and you want to make a leap to commercial, you're going to make more of a better sense of what's happening and how that relates to your own strategic decisions, how that relates to pivots that you might consider making or perhaps should be considering making in your own investing. So today is so valuable. I'm excited about this. I'm excited for you to gain more clarity on where the debt markets are going, where equity is going, and how that relates to perhaps some investment decisions that you may be considering, how things are shifting in the interest rate environment, how geopolitical moves across the world are affecting, more importantly, your portfolio and the way that you make decisions, and so much more. So I'm excited about this conversation. I want to encourage you to buckle up because Elevate Podcast is all about mindset, mind expansion, and personal development for high-performing real estate investors. I'm your host, Tyler Chesser, and I am a professional real estate investor and high-performance coach. It is my job to decode the stories, habits, and multifaceted expertise of world-class investors and other experts to help you elevate your performance and lifestyle. Are you ready to take it to another level? It is time. Let's raise the bar today. I want to encourage you to pay the fee. The fee is to share this episode with one person. All you have to do is grab that link, send in a text message, email, or share that on social media. We just ask very, very kindly that you do so. And that's the only way that we can really grow. And growth is important for us to continue to be able to invest in this podcast, to be able to invest in this community, this platform, which I believe is a movement, and it has become a movement. And Elevate Nation is not just a thought, it is a real thing. And we're just so thankful to welcome you and to have you as a part of Elevate Nation. You're important. You're important to us. You're important to my team. You're important to me. And I hope that it comes through to you through the sincere value that we strive to bring you every single day. So just ask you to pay the fee. Again, that's to share this with one person. Share this episode with one person. If it's your first time listening to Elevate, welcome. And you're going to love this. I really, really, truly believe that you're going to love this podcast. You're going to love this movement. And this is bigger than any of us individually. I also want to encourage you to give us a rating, review, and subscribe or follow Elevate Podcast and wherever it is that you listen or watch podcasts. That is important to us as well. And we appreciate every single review, every single rating. We read every single one from the bottom of my heart and our team's heart. We are so thankful for you. With all that said, I want to introduce you to Jake Clopton. I'm going to do it very briefly, and I will tell you that Jake works with commercial real estate owners throughout the United States, providing finance solutions for commercial mortgages, bridge loans, home builder financing, construction, and joint venture equity. Alongside his equity partners, or their equity partners with Clopton Capital, they deliver highly competitive rates, terms, and structure typically not available through local bank lending. And you're going to learn so much in this episode, and I had so much fun. I hope it comes through. So please, without further ado, please enjoy this amazing discussion with Jake Clopton. Jake Clopton, welcome to Elevate, my friend. How are you?
I appreciate it. I'm good. Yeah, thanks for having me on.
Oh yeah, man. It's funny. Before we started recording here, the first thing you said was, "Man, we live in," I don't know exactly your phrase, but we live in a crazy world, and I could not agree more. In fact, my response was, "We have crosswinds flying in every direction from an economic standpoint, from a geopolitical standpoint, It is an interesting time to be alive. That is for sure. I'm excited about our discussion today because I think it'll put some more context around the way that you think about things, the way that you're seeing things, which will help folks make more sense of this and sort of make decisions in the midst of chaos in many capacities. So I appreciate you coming on. But Jake, if you were to, describe yourself before we dive into this conversation in the way that the people that know you best would describe you, just to give folks a little bit of a context in terms of who you are behind sort of your professional bio, behind sort of your professional image and the way that you add value in commercial real estate, how would folks who know you best describe you?
I would say, my family members and friends and everything describe me as, I would say focused and busy and very family orientated. I have 3 kids under 10 years old. I started my company 14 years ago, right? And I had my first one when I was 29. So, all those things have been growing up and developing at the same time. I would say that, but also, we like to have fun. We like to go out a lot and, definitely a good work-life balance, as cliche as that sounds, is something that's very important to me.
So what do you do to have fun? I mean, what are your hobbies? I mean, what are some things that you like to do, or maybe some things you like to do with your family? Just give me a sense of that.
Yeah. Well, I'm in Chicago, man. And I mean, just one of the best things you can do around here is just take advantage of like all the good restaurants and stuff. I mean, it's like every week there's like some new, like world renowned, awesome restaurant that's popping up. So, that's number one on my list,
I'm with you, man. It's so funny. I was talking to a friend of mine, actually a family member yesterday, and he was like, I'm putting on a team building event in Nashville. And he's like, here are some of the things I'm thinking about. And he's like, Top Golf's on the list and, axe throwing's on the list and this, that, and the other. And he's like, is there anything that you might suggest? And I'm like, man, you guys need to go to this bar. You need to go to this restaurant. You need to go to this rooftop bar. And it's just funny because my mind initially goes to restaurants and bars and things like that. And to your point, it's like, enjoying that experience is fun. So I'm with you.
Oh yeah, man. I mean, I love throwing axes and shooting and stuff too, but nothing beats, good food and drinks. So.
That's exactly right. So going back to kind of what we were talking about as far as, economically in the market and across sort of the world, we live in an interesting time. I mean, it's a very unique time to be an investor and to be making decisions in the midst of crosswinds in every different direction. I want to dive into that, but give me a sense of sort of your background in commercial real estate. When you got involved in the business, you mentioned founding the business, what was it, 14 years ago?
Yep, 14 years ago. Before I did this, I actually traded interest rate futures. So like 3-month LIBOR and treasuries and Fed funds and stuff like that. I have a very good kind of healthy background in like, just interest rates in general. Compared to like most people that I think are commercial real estate, they just kind of know what they are. Like I really know how they work. And then, I started this company, I wouldn't say there's like this day it started, right? I mean, it was
Sure.
a work in progress, right? But, around the 2008, 9-ish era, which, what I do is I'm an intermediary to find borrowers capital, right? And connect the lenders and the borrowers. And at the time, it was a financial crisis, right? And people were having trouble, finding money. And, it was a great, it was a great company to start at the time, right? I mean, if you found money and you found people that are lending, the borrowers needed it and they just kind of came to you. And over the time, it just, I very, very quickly focused on commercial real estate because that's, I love it. I'm interested in it. And, that it's grown since then. And 14 years later, man, we're busy. We do several $100 million a year worth of, commercial real estate deals, and we're involved in both the debt and the joint venture equity side.
And as far as asset classes in commercial real estate, are you involved across all food groups, or give us a sense of any niche or specialties that you have?
Yeah, all food groups, right?
Okay.
So, to a degree, like real estate isn't rocket science, right? So once you kind of understand like, one asset class, it's not a huge stretch to go into another. Understanding hospitality and hotels is a little bit different, but in general, there's still similar principles. One of the things that we like to do is really follow like macro trends and then like what's working, right? So, 1 year I'll be doing a lot of one thing, and then, maybe, that industry or that sector is overdone and overbaked, and so we'll pivot into another. For instance, during COVID, right, in 2020, there wasn't a lot that was working, right? I mean, we did a lot of hotels. Hotels weren't really, going off at a big clip. So we pivoted into home builder financing, right? Because that was an industry that was definitely working, right? There's a huge housing shortage, and we all know what's happened to the residential sector since COVID, happened. So, I mean, that's one of the things that I like to do is try to get in front of macro trends and kind of and go into those, head on.
I think that's really valuable and important, right? We've got to have a sense of where are things going. Like one of my favorite books I've read is this book called Big Shifts Ahead. In fact, I'm looking at it on my bookshelf right now, and it's all about trends. It's all about behavior, in the marketplace. We have to be able to evaluate what's happening to be able to make proper investment decisions. And of course, yourself, in terms of financing those deals, whether it's from the debt side, from the equity side, you got to get ahead of that. And you also have the benefit of deciding sort of what food groups are in favor or are on the right side of those trends to be able to get ahead of that. Many investors, in some senses, may need to kind of pick a lane and stick with that lane until they reach a sort of critical mass before they have that luxury. However, I think it's important for us to kind of build towards that so that you can pivot, so that you can be nimble and adapt where necessary. But man, speaking of following macro trends, let's get into this, because I think this is important. So how are you making sense of what's happening across, the macroeconomic environment, geopolitically? Obviously, we have a lot of interesting things happening sort of in the, in far east Europe and maybe even north of the border here in the US. We have some interesting things going on. So how are you making sense of what's happening in addition to sort of what the Fed has been discussing over the past few months?
I think it's really going to come down to affecting us in probably really in two areas, right? I mean, the easiest low hanging fruit of how it's going to affect us right now, this geopolitical stuff, is really interest rates, right? And then, it all depends on how far they go, right? I mean, if you notice, right when Russia went into Ukraine, there's something called a flight to quality trade, right? Where everybody goes to the risk-free stuff, which is US treasuries and, other ass stuff like that. So very quickly, the first knee-jerk reaction was treasury yields dropped, right? And then, over the past couple of days, they've come back up. But I think if things continue to develop, and let's say Russia goes into Ukraine, and right by the time somebody's listening to this, we'll probably know what actually happened, right?
Right.
But if Russia goes into Ukraine full on, and this turns into something much bigger, right? I mean, yeah, I think rates are going to drop pretty significantly because of that risk off trade, right? And so the 10 year is going to go down, and then I would say probably Fed rate hikes are probably off the table at that point, because there's bigger concerns, right? The other areas where this really will affect people, right, is input prices and energy costs, right? So Russia's a huge energy exporter, right? And the first sanctions and all this stuff that they didn't. Biden came out and said they very carefully crafted the sanctions to not affect energy prices, right? So energy prices haven't gone through the roof, but potentially, that could happen. And if a much larger war breaks out, energy prices are definitely going through the roof, right? And everything, oil ties in everything, especially if you're doing things like building buildings and construction costs, right? It's just going to make everything more expensive.
Right.
The other parts where this could affect us even further is the supply chain issues that already exists. I would say that it's just going to exacerbate the whole thing even further, probably more disruption in supply chain in one way or another. So, I would just say in general, if we go to war or the much bigger altercation happens, I would say higher energy and input costs, and, the rate hikes probably off the table. The higher, costs of inputs and oil and all this stuff probably gives the Fed what they wanted to slow down inflation anyways. Plus there's a lot bigger issues. So
yeah,
that's that. I mean, but the whole thing is there's so much uncertainty, right? I mean, the narrative changes every hour, it seems like. So it's hard to really tell where this stuff is going to go right now. Again, by the time somebody's watching this, they'll probably know, but that's where we're at.
And by the way, I mean, we release these episodes very quickly, but to your point, I mean, things are moving so quickly. It's extremely difficult. You got to keep your finger on the pulse.
Now. We don't know. Yeah,
I know. I mean, we're recording this on February 23rd, and so we'll see how things play out. And obviously, I think it's important for us to understand sort of probabilities of outcomes, what may happen in that circumstance, what the contingency plan looks like in that case, what it might look like in another case. So let's talk about, let's say that, tensions maybe calm down, and maybe they ease, maybe we don't have a significant altercation or anything beyond that. What's your sense of how things might play out in that scenario?
If that's what happens, I think this is a big non-issue for a lot of people in the US, right? I mean, they didn't affect energy prices. I don't think, supply chain disruptions are going to happen. And the narrative as far as people in the US, right, it's going to go back to earth. I mean, the great thing about real estate, right, is if you own a building today, this hasn't affected you. If you own stocks, it's a little bit different story,
totally.
Right? There's a great marketing piece for owning real estate versus equities. But I mean, as far as the trend of where rates are going and input costs, it's not going to affect it. It's the bigger altercation that it could possibly happen that could affect real estate owners in two ways, right? Like higher energy and input costs for building, which we already have a problem with that today, and then actually, maybe you get a better interest rate on a loan you may be closing in the future. So, I mean, there's ways to take advantage of it, probably not if you're trying to build something, but, you're trying to refinance or acquire something. Sure, maybe. Yeah.
Well, the imagery that I think of in this circumstance, and I think for high performing real estate investors, it's let's be an eagle instead of a crow or a duck, because what the eagle does, the eagle flies above the storm. I don't know if you know this, but literally an eagle flies above the storm. When you have something significant happening from a weather event perspective, I think that's an amazing thing to think about, because it's not like we avoid the storm, we just fly above it. And so we can look down and make decisions as appropriate. And so with all that said, I mean, I don't think you want me to put my tinfoil hat on. But if I did, I could talk to you about where I think, some of the bigger picture lies in terms of why certain things are happening geopolitically, how that relates to inflation, how that relates to, some shifts in the way that governments are operating across the world. And I think it's all very interesting. And I think it's important for investors to, not necessarily say, all right, well, I'm going to lean one aisle of the political spectrum or the other, but it's just to have an understanding and to see things as they are rather than to have our heads in the sand. And so I would love to know, from your perspective. Now let's just look at this and say, all right, we're flying above the storm. We understand that there are certain circumstances that may play out in one direction or the other. Things are always changing, but let's talk about the debt market outlook for commercial real estate in general. I mean, obviously, as we entered 2022, the narrative was in one direction in terms of the Fed saying, look, there's no question to fight inflation. We've got to raise interest rates and we've got to, quantitative tightening and all these kind of things instead of the easing that we've seen for the past decade plus. What do you see in terms of how this is unfolding from a financing perspective? I'd love to know from a debt perspective, and then we'll talk about equity.
Sure. So there's a couple different, angles of how we view the debt market state. I mean, so one, going back to the recession from coronavirus, right? It wasn't a financial crisis, right? So back in 2008, nobody's lending, yada, 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 right? Financial crisis, and there was low liquidity. We don't have that problem today. There is so much liquidity sloshing around the system and on the sidelines and all that stuff. That's not the issue. So there's tons of money to be lent out there. There's tons of equity to do deals, right? It's all looking for a home. There's no problem with the lending and debt markets at all. We are hitting that era or that area where there is, I would say, a repricing of risk going on, where I would say last year, everything was super inflated as far as asset prices. And I think today, once you start getting this like Fed talk of pulling back in QE and maybe raising the Fed funds rate, you get people that start to say, hey, well, what are the assets that are potentially at risk? And then they say, well, maybe the price in this asset is too high, right? So they start pulling it up. what that really means to me, as far as repricing of risk really like prices itself in credit spreads over the index, right? And not to get too technical, right? But when you do a loan, they price your loan as X spread over, let's say it's a 10-year loan, over the 10-year treasury, right? So you've got, let's say you're going to do a CMBS loan, maybe it's 200 over the treasury. And as I think what we're going to go through in the short to medium term is repricing of risk, and credit spreads will most likely widen. So even if the 10-year treasury rate, the index, didn't really go anywhere, I think you're probably going to see that come through as higher coupons in the short to medium term because of that repricing. And there's a good proxy that you can look at to see where high yield debt is going, and commercial real estate debt is high yield debt, right? So if you follow the HYG high yield ETF, when that thing gets sold off, you can kind of see like a risk repricing kind of going on, and that's what's happened recently. As far as inflation, it's my conspiracy theory that the Fed really wants inflation so that they can inflate away some of our national debt, because once you start doing QE, you're kind of boxed into how much you can raise rates, right?
Totally agree. By the way,
it's like having a person with not a lot of disposable income, right? They can only afford so much, but if you inflate away the debt, then you get more wiggle room, right? And so, I mean, that may be one of the reasons why they're not saying it, but also at the same time why they're letting it get away from us. What I'm telling people today is, listen, save your equity today. Get as much debt for deals that are going to work out, as long as you're comfortable with it, right? Don't over leverage yourself, but get as much debt as you can, if you've got good margin in the back end. Because, okay, what was inflation? Realistically, 7%, right? So you're telling me this loan I'm going to take on today is going to be worth 7% less next year? Well, okay, maybe my rate is only 4%. So my real, what am I really paying? Negative 3%?
Mm-hmm.
Like they're actually in real terms paying you to take their money. You know what I mean?
By the way, only if you're looking at CPI. I mean, otherwise, I think a lot of folks would say, hey, inflation's significantly higher than 7 or 7.5.
Yeah. Right. So if you look at the inflation indexes, you'll see they throw out a couple things that, if you're like a real person, you feel those things, right? So you throw out energy and food prices, but those are real prices.
Well, and it's such a good point. I mean, you look at how the shift or weighted sort of calculation of certain items within the CPI have changed recently, and you're still seeing historic numbers in terms of that reporting figure. So I think there's definitely some engineering going on there. I think anybody who looks at it with common sense would say that there certainly is, and that headline number is trying to be suppressed a little bit lower. But the fact of the matter is, we're seeing significant inflation. So to your point, it's utilizing that to your advantage and not saying, hey, this is good or bad. It's all right, this is a set of circumstances, so now let's act.
At the end of the day, it's all just a math problem, right?
For sure.
It's about positioning yourself to be in the most advantageous spot in that math problem. And today, knowing that whatever equity you put into something today, you're potentially taking on that inflation liability versus if you use debt, somebody else is, and as long as you're going into a good deal, I think that's probably a smart move. As long as you're a sophisticated investor and you know what you're doing. I'm not telling people to go out there and get $100,000 on a credit card, but I think that's something that, given the right circumstances, you definitely take advantage of.
Yeah. And it comes down to what our friends over at the real estate guys would say, it's education for effective action. So you've got to educate yourself to become that sophisticated investor if you're not there yet, because this all can be very dangerous. To your point, debt and leverage can be a double-edged sword. That can be extremely dangerous and detrimental to you. So thinking about, all right, well, how are we doing this wisely? Not only utilizing it for what it can be to lever our returns, but to be careful and to mitigate that risk. But talk to me about multifamily. When I think about bridge versus agency, I mean, I think there's some unique stuff going on there, but how do you think about that? How do you look at sort of those options and how things are unfolding on the multifamily side?
Yeah, I mean, as far as like bridge versus agency, it all comes down to like what the strategy is on, on the ingoing and the exit strategy, right? So I mean, if it's value add and you're trying to capitalize a capex budget, just forget about agency because they don't do that, right? So it's bridge. The bridge space is pretty competitive, right? I mean, I'm pricing right now a bridge deal that's 85% of costs and not LIBOR, SOFR plus 300.
Mm-hmm.
That's pretty non-recourse. That's pretty competitive. And what you saw, the last go around before 2020, it was kind of just this race to the bottom, right? In rates, spread, right, for multifamily bridge and pushing leverage higher and higher. And that's a lot of that like CLO money, right? That goes out in that kind of like rate and structure capacity. Agency, it's your tax dollars hard at work. If you're looking for a 10-year perm loan, that's the place to go. There's not a lot of other alternatives, especially if you want non-recourse 80% LTV and it's a $3 million loan. That just go to Fannie Freddie, right? I mean, that's the place to be. They're gonna by far have lower interest rates than the vast majority of lenders out there. The drawback to agency, however, is the prepayment penalties that come along with it.
Mm-hmm.
Right? So and this is why people ask me a lot like, oh, should I do an agency deal? Well, I don't know. I don't know. It's an investment. I don't know what your investment profile is. If you want to reevaluate this thing in 5 years, don't get into a 10-year deal, right? I mean, I know you want the interest rate locked for the whole period, but I mean, legitimately, if you want to recap this thing or sell it and then 1031 into something else within 5 years, you're going to be mad at yourself in 5 years when they tell you your prepay is like $500,000. So
yeah,
definitely having some forward-looking expectations as to like when you can get out of this thing and stuff like that. It really matters when you're doing agency deals and really anything that's securitized and sold off after it close.
Mm-hmm. And I almost think about it's just options. You got to give yourself options because, like we were just saying, I mean, we don't know how next week is going to unfold, much less 3, 5, 7 years in the future. We have to have some probabilistic thinking and to put ourselves in the best position to have options, because if you only have one option, then in my opinion, you really have none. And that kind of puts you in a challenging position. Would you agree to that?
Yeah, I would agree. And then like, I think that also ties into another thing that I deal with quite often is, people trying to predict where interest rates are going to go. I mean, like, well, should I lock this loan today? Or, my aunt's brother is telling me that interest rates are probably going to go down because they came up so much. They could go the exact opposite direction. Like I used to trade interest rates for a living, and I try to telegraph to people like, you don't know where it's going to go a month from now because they're so sensitive to so many different things. Some Eastern European country could be going to war and it can move huge. That's got nothing to do with you or even in this country. It's an international product, right? So, what I always tell people is like, listen, if it's a good rate today, close it today. Don't worry about it where it's going 2 months from now, 3 months from now. I would tell you probably the long-term trend is up, but in the medium term, you have no idea. Nobody does. It's
like a bird in the hand is worth two in the bush, right? It's like you have certainty of what you have today. So make sense of that based on where that fits in the historical perspective. You're looking at it and saying, all right, well, in comparison to, the 1980s, we're double digits plus, this is a significant, still a historically low interest rate environment. So that's really wise counsel.
And your real rate's like -3%.
Exactly. Like we just talked about. Yeah.
Right.
What do you make of the shift from LIBOR to SOFR? I'm just curious.
It probably needed to happen. I mean, I used to trade LIBOR for a living. So the way that LIBOR prices every day, I get it. They were just kind of making up the rates for themselves, right?
Can you talk about the differences between the two?
Yeah. So LIBOR is the London interbank offered rate, right? And it's really the way it prices every day is there was like an agency over in the UK, and they would call around to, I think it's either biggest 12 or 16, money center banks and say, hey, where are you lending money to each other today? And they would get their fixings, and then they would take the average of those, right? SOFR's a little different. SOFR's more of like a government overnight rate. And it has its own structural problems. I don't know SOFR as well as I knew LIBOR, but SOFR's more, I would say, sensitive to like short-term liquidity issues in like, overnight repo markets. So we're getting really sophisticated here. A couple of years ago, SOFR kind of exploded out of nowhere, and then that they were talking about that and how it may not be the best alternative for LIBOR. But at the moment, it's all we got. So it kind of is what it is. I don't know how many hedging options there are for SOFR yet, like there were for LIBOR, right? So a lot of times we do like a multifamily bridge by LIBOR cap. They're pretty cheap, right? I've been watching kind of the futures markets for SOFR, and they're just not as deep as they were for Eurodollars, which is the LIBOR futures. But I'm sure, that will develop over time. But I think, and I haven't really gone on this road yet, but I think people that are probably pricing SOFR caps are seeing them a little bit more expensive than LIBOR caps were.
So why do you think that it was an appropriate time to make that shift?
I think once you get, that level of fraud in anything, it's probably best just to move away from it. There's really, it's not a direct alternative, but I think it's the best alternative other than just using, the Fed funds or prime rate to price these things.
Hey guys, just a quick word from our sponsor, then we'll be right back to the show. This episode of Elevate is brought to you by CF Capital, a national real estate investment firm founded by myself and my business partner, Brian Flaherty. CF Capital's mission is to provide property investment and asset management solutions to help investors like you maximize their returns by investing in high-value multifamily communities. If you are looking for risk-adjusted alternative investments in quality apartment communities, are seeking tax-optimized cash flow with appreciation upside without all the hassles of management, you might benefit from learning more about investing alongside our team. You're invited to reach out and learn more about how you can invest with us by visiting cfcapllc.com. We're also currently offering a free ebook called The Bottom Line, 10 Ways to Increase Cash Flow in an Apartment Complex. Whether you're a new or experienced investor, we're confident you'll find massive value in this resource. So go get your free copy today at cfcapllc.com. And now, please enjoy the rest of the show. Hey guys, my friend Damian Lupo just informed me that checkbook IRAs have been made illegal by the U.S. tax court. That means if you have a checkbook IRA, your holdings are now disqualified. That means taxes and penalties of up to 50% or more. Don't panic. Damian and the EQRP company can fix this. Lucky for you, those IRAs can be converted into EQRPs. Plus, you can do this retroactive to the last year, getting tax deductions and reducing your taxable income from last year. Want to invest your 401k or IRA in real estate, Bitcoin, gold, or even your own business? You can. Whether you're a full-time investor, retired, a dentist with dozens of employees, if you're listening, you qualify. The EQRP works and is your secret weapon. And now it's retroactive. They have your solution. By the way, if you got bad advice and use an IRA for an apartment syndication, you are sitting on a UBIT time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill UBIT, and help you pay way less taxes. Want to learn more about this strategy? Simply text the word ELEVATE to 307-213-3475 for Damian's brand new 2022 EQRP special report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending a text to 307-213-3475 with the word ELEVATE. Fair enough. Fair enough. So let's talk about equity now. I mean, obviously, thank you for giving us a sense of how you're looking at the debt markets and how things are shifting. And obviously, you don't have a crystal ball. You can't look around and say, here's exactly what's going to happen. But obviously, your experience lends itself to understand sort of how things would cascade if certain circumstances unfold and what that looks like today, how that fits into the historical perspective. But in terms of equity, let's talk about that. I mean, in terms of the outlook on equity, talk about yields. Let's talk about flow from certain assets to others based on where we're at currently, how that's unfolded over the past 12 months, where that, you project that to unfold here over the next 12, maybe 18 or 24 months.
I mean, as far as equity, there's probably a couple of things I could say here. I mean, one, as far as yields, rates are going to come up, right? And I think a lot of people are saying, oh, as rates come up, cap rates will come up. I don't know. I don't totally think so, at least not to the degree that I think people are expecting. So if you look, I think the best case study for this is really the West Coast of the US, right? And even since 2008, as yields rose, cap rates continue to go down there. And why? Because there was so much equity coming into those areas from Asia, right? And I mean, there was literally equity being laundered through Vancouver and ending up in real estate deals in Washington, Portland, California, in Seattle, all those places, right? And so really what you saw is, like you could only get debt at like 65% leverage, right? And the rest was all equity. I think we're going to see that to a degree, but in the rest of the country, right? And the areas where, you're probably going to see it most prominently are those like secondary markets that, people are starting to target now. And maybe other asset classes that people are really starting to target right now. The one that I think probably is going to see the most obvious implication of that is probably mobile home parks, manufactured housing communities. It's a very, it's not a huge leap for a lot of, equity guys to say, hey, let's go look at these mobile home parks. It's still habitational, it's still residential, but things are getting like 8, 9, 10 caps.
Mm-hmm.
I'm seeing people aggregate smaller parks right now into larger pools and get that cap rate arbitrage of like acquiring them at 8 caps, but selling them once they hit critical mass at 4.5 caps. Right?
Mm-hmm.
It's the same thing that we saw go on in the self-storage market as well. As far as what I think is going to happen to yields, I think just the massive amounts of equity that have been created are going to continue to keep cap rates low and probably push them even further down.
And I almost think about too, it's like, from what I understand, there's still a significant enough spread historically between cap rates and interest rates. And that's still a pretty significant gap there. So there's even room for that to compress and for us to be in a normalized environment. Do you agree?
Right. Yeah, no, I mean, I think that's a good way to look at it. It's all, comparative to what the alternatives are. Right. And the thing is, there's a lot more ways to make money in a real estate deal than just the cap rate.
Sure.
Right. So there's appreciation, there's economies of scale, there's better management, XYZ, right? So it's hard to look at a deal just in what the cap rate is, and really understanding everything that's going on. It's hard to look at any deal and what the posted cap rate. I mean, if you go on LoopNet, I don't know what the real cap rate is in those deals, but I guarantee it's not what's in those OMs. So it's hard to know exactly what's going on. But, I would say in general, I think the actual real yield of deals is going to be continue to be compressed by how much liquidity there is in the system.
Yeah, it's a good point. And like in our firm, I mean, of course, cap rate is a great sort of foundational way to look at a deal. And it is a data point that we pay attention to. But we're not buying these deals all cash, and most investors are not, because leverage is a phenomenal tool. And as we mentioned earlier, it can be an amazing tool. It can also be dangerous if you're not utilizing it in the right capacity. One of the things that we're looking at is, hey, what does the cash on cash look like? And what is our business plan to this project? And what's our overall return on investment, or, internal rate of return that we project? And of course, you can look at any deal, you can give me a spreadsheet and I can make it work. And many of our colleagues would say the same. And so we have to have a sense of reality, but thinking about it from that perspective, thinking about it from a yield perspective, while properly financing deals, it seems like you kind of think, hey, we're going to be at least remaining flat or perhaps even compressing further just on yields from that perspective. Or what are you thinking, Jake?
Yeah, no, I mean, I think that's right. So another trend I've noticed, right, is as property level yields tend to compress, right, you get people that engineer ways of arbitraging, better yields. And now we're up in the equity stack, right? And one thing I'm seeing now is differentiation in the way that people are raising equity and what they're actually paying those equity investors.
Right.
And something I'm seeing that to me means that we're going to continue to see very compressed rates is I'm seeing guys able to raise equity, let's say in a fund, right? That's going into real estate equity, and they're paying those equity investors out of that fund an 8 dividend, a 9 dividend, right?
Just flat.
Right, just flat. But that money is going into real estate deals as equity, right? And we all know the real yield on those is maybe much higher. So if all they have to pay their investors is an 8 pref, right, and then they get nothing else, not even any upside. I'm seeing deals go off like this.
Sure.
Then to me, it's like, hey, they'll continue to buy deals all the way up until they're at let's say an 8 cash on cash, right? I mean, or at least close to it, because that's where it still works. So, I think, there's a long way to go before you really reach the top here.
It's a good point. I mean, you see that a lot, or at least I see that a lot, where folks are structuring their deals where there's a class A and B equity structure. And from an investor's perspective, or from equity perspective, there's times where it makes sense to, have a little bit of risk mitigation from a straight pref perspective that's a little bit higher yield than maybe hoping for additional appreciation or projecting additional appreciation with, less of a guarantee along the way. And so there's an interesting case to be made for that. And of course, to your point, from a sponsor's perspective, that helps make deals pencil a little bit better in terms of that overall yield. And sure. So I think it does
worth it to them to get done at very high prices.
Exactly. Especially
part of the trend here that I've noticed, and I think if you were able to get this data off of LinkedIn, the amount of people that I think, classify themselves as syndicators has probably exploded. I'm going to guess at least 10 times over the past 18 months.
What do you make of that?
I think it's really interesting. I think, I think there's probably a couple unsophisticated people that are doing it. I also think somebody is going to get pinched for selling real estate securities when they're not saying they're joint ventures.
Sure.
So that's something I think people really need to pay attention to. But as far as you're an investor, I'd say, just be careful about who you're syndicating with. There's a lot of good sponsors out there that have owned their own portfolios and that I work with personally that are great, and they're going to continue to be great and invest alongside, right? But there's probably some people out there that you got to be careful about. And I think the biggest issue that I do see coming up here is, what constitutes a real estate security. And it's kind of like autopilot, right? I mean, as long as deals are going along okay, nothing's gonna happen, but some are gonna go down, and then the SEC might come knocking on these guys' doors and just make sure you're doing things correctly. Securities law is not complicated, and I think there's people that don't know about them that are doing syndications.
I totally agree. I think it's a sign of the times. I mean, we've been in a bull market for over a decade at this point, and that lends itself to it's interesting. You look at one of the biggest search terms on Google, and this is aside from what we're talking about right now, is how to get my real estate license. Across the country, people are wanting to get into real estate. They're quitting their jobs, their corporate jobs or whatever, and they're saying, you know what, real estate market's hot. Let me just go and get my license. And I'm sure we're seeing a massive uptick in realtors and things like that. And so where does that shake out? How does that, here's the thing, man. Every market cycle, I believe, the stats will show this, will shake out some of the folks that are not performing or not making the appropriate decisions. And so I think the market always corrects that naturally, but I think it is an interesting thing to point out.
Yeah. And the trend that I'm seeing personally is I would guess main streetization, if I can say that right, of commercial real estate, right? I mean, commercial, I'm starting to see like small commercial buildings. That's the fix and flip of 10 years ago now. Mm-hmm. And I'm just starting to see that more and more happening, like more people interested in commercial. And I've got people around Chicago that I know are residential guys. How do I get into doing commercial deals? That's and the other. So, I think over the next 10 years, it's just going to be really, really interesting. Like commercial real estate is always this it's like a small industry that nobody ever really knows how they got into it, right? And then one day you just found yourself doing it, right? Mm-hmm. But I think the amount of people in it is going to continue to get bigger and bigger. Look what Grant Cardone did off of Snapchat, right? I mean, these are commercial real estate guys. So I think there's it's definitely getting a much broader appeal than it used to have, and it's not quite as boring as it used to be.
Yeah, that's I like that. And I think about it from one perspective. I'd like to hear what your thoughts are when you think of like small commercial buildings today being kind of the fix and flips of 10 years ago in the single family residential space. I think that's a really interesting concept. And it almost seems like the set of circumstances that we've been dealing with, that we are dealing with thinking about macroeconomics, micro, and so forth across, this country and otherwise, people are being forced to one end of the yield curve or the risk curve, perhaps, that, maybe they hadn't been previously. And maybe that's a function of that. I mean, is that how you look at it?
Yeah, I do, right? Obviously, people being the people that used to be able to fix and flip residential, right? The margins aren't quite as there, right?
Mm-hmm.
So you've got to be. I think there's less deals to go around and more equity looking for deals. So as it happens, you're just going to get people that are going to go to other places, right? And look for more for yield in different areas. Like, I mean, again, I'll go back to mobile home parks. That's one of the biggest canary in the coal mine right there of people looking for yield is I've got guys that, are raising funds out of Manhattan and leaving their condos in Manhattan to go drive around Alabama looking for mobile home parks.
Yeah.
You know what I mean?
That tells you all you need to know.
Yeah, I mean, New York equity looking for mobile home parks in New York. So, I mean, that gives you an idea of kind of the search for yield that's going out there. And, it's not just a search for yield, it's a search for good yield, right? And so those areas where people can find it, I think is really, where the money's going to go. And then, go the small balance commercial space. I think people that were doing fix and flips and, going into there are going to be pushed into commercial. And also it's something that hasn't been really pushed very hard into the general public yet, but it's happening now, right? Through crowdfunding,
mm-hmm.
through various things. I mean, I see Nitya Capital's commercials on CNBC. Before, I only used to see that guy on LinkedIn. So it's getting a much broader appeal. And I think, the first step is somebody invests in some crowdsourced deal. And then the next thing they're like, hey, maybe I'll do this myself, or, so there's probably various ways to get into it, but I think it's going to become more mainstream.
To your point, in this part of the market cycle, I think it behooves any passive or active investor to kind of do your homework and your research a little bit more, surround yourself with folks like Jake and engage in these type of conversations because, man, there's a lot of crosswinds as we have been kind of discussing in this conversation thus far. But even just, hey, who are you investing with? What does their track record look like, and how do they weather uncharted territory? How do they sort of enhance their own sort of business plan or enact contingency plans when things go, the different direction? Because that's always a possibility, man. This is, things don't always go up. I know that memes want us to think that, stocks and real estate and everything just always goes up. But guess what? 2008 reminds us that is not the case. But man, give us some tips. Give investors some tips to navigate the crosswinds of this economic environment. Is there anything else that you would add aside from what we've already talked about?
As far as owning real estate, right? If you're looking for a deal, I think if you're going into the right local economy, right, where there's lots of population growth, local economy is doing well, there's job growth, and then pay attention to the coronavirus restrictions, right? I mean, if you're buying a hotel, you never know, it might get shut down if there's what Zeta variant, whatever, right?
For sure.
But I think as long as you're going into a good, strong market, and you want to buy, let's say, residential or multifamily, so you're probably gonna do okay, right? There's ways to screw it up, and I think the biggest way that a lot of people really one misconception of commercial real estate is a lot of people are like, I'm going to buy this investment and it's going to sit there and just make me money. It's not an investment. It is a operating business there. And if you think it's anything otherwise, you're going to learn that very painful mistake at some point in the future. Don't manage it yourself unless you're a property manager. I get a lot of guys who are like, I own 3 houses, I'm going to operate this 20-unit apartment building. I don't think so. Get a property management company. You know what I mean? Figure out what they do for a couple of years and then manage it yourself. It's I guarantee you, and this just happened to me, I own 3 buildings in Chicago. Eventually, somebody's going to fall asleep with a cigarette in their mouth, and the mattress is going to go up, and you're going to have a fire unit, and that's going to happen, and you're going to need people to help you to do that because you're operating another business. So there's suspiciously specific scenario that just happened to me 2 months ago. But that's what I say. Align yourself with the right operating partners, right? And do that first. Don't find a deal and then go find a property. Maybe call around the property managers first, ask them about the right areas, invest in. A lot of times these guys have properties in their manager portfolios that people are selling. You get a good crack at those first, right? I think building out your own team of operational and then maybe support and maybe touch base a couple finance people, that's really the first step, because everybody wants to get a loop net and just find deals. But I think building out your business side before you go start the business is the most important part.
That is so valuable. I think it's important, and that's one of the reasons why we focus on this podcast and mindset, mind expansion, personal development, because those things can allow you to be a better business owner, operator, decision maker, because it's not just, it really in many ways is not autopilot. Even if you are a passive investor in a larger deal or in a fund, I mean, you've got to actively be making decisions and, implementing a strategy based on everything that's happening and based on your goals. And so, on that note, I wanted to actually kind of shift gears just a bit in terms of the way that you think about life and the way that you think about, how this fits into the bigger picture of your goals and sort of your outlook. You shared your life rules, man. And I'd love to hear that. You shared this on LinkedIn. I'd love for you to elaborate on your 10 life rules and what that means to you. But are you open to going into that?
Sure, let's do it. So that's so funny you brought that up. I originally I have a couple principles that I just kind of do day to day, right? And I originally put that together as just for my kids, right? Hey, what if I walk out the door and bus hits me? I've got 3 young kids, right?
Mm-hmm.
What is some good advice that I could read for? And so I kind of spent some time writing that stuff up, and some of that stuff I've learned from other people. Some of those are some Arnold Schwarzenegger principles. I think there's an Elon Musk one in there.
I love that.
No, it's great. So that's really where it came from. And it's generally speaking, it's one of those philosophies where you make it's kind of like that book, The Tipping Point, right? Where it's generally you make the right, risk reward decisions consecutively over time. And then, look at it in a longer burn, and eventually things tip in your favor.
Mm-hmm.
Right. So, I mean, that's also one of the, just a general concept of the rules I put together. I can't name them all off the top of my head, but they're written down. They're also on my LinkedIn, as you know. So, I mean, that's kind of why I did that. And I think, generally speaking, a lot of it has to do with, my experience of, go out and do the things that you really want to. Don't worry about oh my God, is this going to work out? But you know what? I have screwed up and failed so many times at things, but eventually, those you learn from those, and it's kind of like walking down a hallway, and the failures are what kind of creates the walls, right? And eventually, they kind of point you in the right direction of where to go. I started my business, Clopton Capital, 14 years ago. I had no commercial real estate background at all. I knew commercial real estate was made out of bricks, and I was sitting in a building. That's basically all I knew about it. So I knew the concept, and I just started making phone calls and doing it. And I think at this point it made 500,000 cold calls or something like that.
Wow.
Feels like it. But I mean, that's just kind of how I started, right? I mean, I wasn't worried about oh my God, well, I don't have a degree in commercial real estate from Northwestern, but it was just
Mm-hmm.
it was the concept of what I was doing. And then I knew eventually, if we kept going the right direction and, and pushing forward, it was going to work out.
Yeah. And I'll just recap them because I've got them in front of me. And the first one was to what you were alluding to is don't be afraid to fail. So that's the first one. I love that. And by the way, we'll put a link in the show notes as to where the listeners can find this on LinkedIn so that you can see the elaboration, because each philosophy has a bit of an elaboration, which is very appreciated. And by the way, another comment while I go through this is borrowed wisdom is beautiful. And we have the opportunity of borrowing wisdom. And that's one of the beauties of a podcast is, hey, if you hear something, you want this to be one of your life rules, go ahead and take it. If you took it from Elon Musk, that's amazing, right? We have that opportunity. The second one here is always ask. And, of course you elaborate on that. I think it's surround yourself with other people, and ask. And that was a big lesson that I learned early in my commercial real estate career as well. It's because I was too afraid to ask because I didn't want other people to know that I didn't know the answer. But I think there's a lot of wisdom in that. I'll continue. Break the rules is another one. Control your emotions and trust yourself. That's another one. Consistently accomplish small goals. Love that. It's okay if other people don't like you. Sometimes you don't need to think. Recognize patterns and take advantage of them, which has been a big, part of our conversation today. Risk less than you get back as a reward. Love that. And then lastly, minimize your regrets. So Jake, I appreciate you sharing that and appreciate you giving us a look into how you look at things. And I really like that thought too of, hey, let's put a contingency plan in place for our family and share that wisdom and principles and timeless wisdom with them in case that you're not there to teach it to them so that they can embody that and move forward. But Jake, this is fun, man. I really appreciate this conversation. I want to transition into our rapid fire section of the podcast. It's called the Rare Air Questionnaire. It's all about being uncommon. I think our conversation today has been uncommon in the fact that many people, are not willing to have these conversations or to put political differences aside to look at things as they are and make decisions in that way. But we are, and I've appreciated that. So let's talk about a few things. I'd love to ask you if you had to point to 2 or 3 of the most impactful books that you've read over the past few years, what would those be and why? You mentioned The Tipping Point, and by the way, it's a great book, but are there any others?
I gotta tell you, man, I struggle a lot of time to read full books because I read about 30 different news articles every single day.
I feel that.
Yeah.
So, well, are there any news sources that come to mind or that are really important for you?
Yeah. So I'll bring up my RSS feed here, man. There's a great resource for anybody that wants like a good synopsis of current real estate articles here. There's the Wealth Management Real Estate does a top 10 reads of the day. That's pretty decent. The other stuff I read here is again Hospitality Net, Ion Housing, Inside Self Storage, CNBC Real Estate. The NIOP newsfeed, banking regulations and risk. I'll throw this out there. I write for Benzinga, so read my articles on Benzinga.
Okay.
I am about this close to being done with a book myself. So I got that going on too. I'll let you know when that comes out. I'm kind of toying around with just putting it on as a free download on our website. But it's basically, a lot to do with commercial real estate trends and capital markets. The other most recent books that I've read and I really enjoy are Freakonomics books.
Oh yeah.
Yeah. So I mean, I was an economics major in college, and I was kind of how applying that to weird scenarios works out really well. And they applied it to I think it's the Kobayashi hot dog eater guy at one point. So those are cool. I do like reading those. So that I would say those are the most recent ones.
I like that. I think there's some really good tips there, and appreciate you sharing that. Hey, you're reading 30 plus articles on a consistent basis. And obviously it shows. I mean, in terms of having a pulse on what's happening, I'm sure you're recognizing patterns, right? You're seeing differences, but you're seeing the bigger picture, and you're able to kind of synthesize that by continuing to read and stay abreast of things. But man, I'm like you. It's I just endlessly am fascinated with the macroeconomic circumstances of today and how that fits into historically. And it sounds like you just can't get enough of it yourself.
Yeah, I mean, it's really what's allowed us to be successful, right? I mean, my biggest year was 2020, and then my biggest year after that was 2021. So it's one of those things. So a lot of stock managers, right? I mean, it's kind of like picking the indexes. You get out of the index when it's high, and then you go into the different sector and then ride the wave up. That's kind of the way that I think about, going after macro trends in real estate as well, and kind of pivoting our business into there. Where's the most money going? I'm going to get involved where there's the most activity and where there's the most equity going on, and where there's the most competitive lending landscape, and take advantage of that and ride the whole, secular wave up. And then when apartment cap rates are 3%, figure out something else to do. You know what I mean?
That's exactly right. What's the biggest way that you elevate your life on a daily basis, Jake?
trying to be better the next day than I was the one before.
And how do you do that? I mean, is it just sort of a feel, sensory acuity? It's like, all right, now let's improve on things that we failed on, or what does that look like?
Kind of having like goals that I'm working towards and always adding on, but at the same time, not losing what I did previously. Mm-hmm. Right. So it's a constant addition, right? It's kind of like going to the gym and lifting weights, man. It's like, you don't walk into the gym and start throwing around, 100-pound dumbbells day one. You work up to it. But as soon as I'm doing, 100-pound dumbbells, I don't go back to the tens.
Right.
So yeah, I mean, it's about upkeep and not losing what you've already gained through experience and, knowledge and everything, but then continue to add on to it. Mm-hmm. And actually have it following through on those goals in the first place and actually doing it. So.
Totally agree. I almost look at it as the compound effect, and that continuation of stacking starts to become exponential. So that's awesome. What's the biggest way that you elevate others around you?
Well, that's a good question. I don't know. I'd have to ask them. I try to take as much, genuine pleasure myself out of doing things for other people. I'm not worried about just, what people think about me, but just the general concept of being generous, over tipping people when I go to restaurants, being nice, doing nice things for my family. Those things tend to come back to you in, multiple dividends.
That's awesome, man. Well, Jake, this is really exceeded my expectations. And by the way, I had high expectations for our conversation today. And I just want to acknowledge you for your commitment to learning and serving your clients, growing your business, serving your family, leaving a legacy. There's a lot to point to and a lot to aspire to for many of the listeners. And I just appreciate you. Is there any parting thoughts or words of wisdom that you'd like to share with Elevate Nation today?
Well, you've covered all my words of wisdom. No, man. I mean, I would just say, like, listen, things are, we're in a very fast-paced, kind of dynamic environment. Now, I mean, economic trends that used to take years to change are changing overnight now. And I think, you can do the thing where you just get involved with something and stick with it, and maybe just coast it out. Or there's a way to take advantage of it. And it's really staying up to date, day to day, with what's going on. And again, recognizing the patterns and trying to pivot into the areas where you see upside. And I think that's as true today in real estate as it is in anything else. So
that's actually a really interesting, and I wanted to just quickly follow up. I've heard someone mention this recently, and obviously I think it'll be interesting to see how things play out and if this truly is the case. But, historically, commercial real estate cycle has been about 10 years. What some people are saying now is that the cycle is now compressed to maybe more of an 18 to 24 month type of period, or maybe even further compressed time frame than that. I mean, what's your take?
Yeah, no, it could be.
Because of technology and because of, speed of communication.
Well, if you think about where the income stream is coming from, right? Like everything's a derivative, right? Real estate's really a derivative of the people that are renting it and paying rent for it. And and those companies are a derivative of the overall economy. And there's technology in the way, right? And on the corporate level. And, if you look at what's going on in retail and industrial, great points here, right? And there's just so much going on just constantly with tech development in retail that's also affecting industrial, because everything's going e-commerce, right? And so you're getting, a lot of tendency that I think capital that used to be going into retail that's now going into logistical space for warehouse, and that happened fast, right? And especially when you have things like coronavirus, that was just a trend accelerator, right? In every way possible, right? I mean, coronavirus didn't start trends; it exacerbated all the trends that were already happening, I think. So I think it definitely an 18 to 24 month cycle. But even on the residential side, right, in multifamily, there's definitely things that will, affect that. For instance, if I was just hearing, that, our ambassador Yun was saying is if Russia overtakes Ukraine, 5 million people will be displaced. I guarantee a lot of those are coming here. That could be, that's maybe we get 1 million of those people. That's 1 million more people in your houses in an already supply constricted industry, right? So things can change very quickly. It doesn't matter what field you're in, right? I mean, hospitality also, that changes overnight. Right?
Mm-hmm.
So yeah, I think the cycle's definitely narrowed. So definitely staying on top of trends and knowing what's going on, even in other parts of the world, will be important.
Jake, this is good stuff, man. I've really enjoyed our conversation. I feel like I could go for like a few days in a row now and maybe take like a nap in between and come back to it. But we'll continue the conversation, I'm sure. But tell the listeners where they can learn more about you and your business.
Yeah, well, I'm personally unbelievably easy to find. LinkedIn, Jake Clopton. I think I've hit the connection max, but you can follow me. My website, cloptoncapital.com, or just call us directly. I'm always ready to chat.
Awesome. And we'll put links in the show notes as where the listeners can find you, Jake. But again, my friend, until next time, thanks again for being on the show.
Likewise. Appreciate it.
Elevate Nation, what an awesome conversation with Jake Clopton. And I just appreciate him because, we were all trying to make sense of what's happening economically, macroeconomically across the world, across this country and in the regions and markets that we focus on. And so I hope that this was helpful for you to make more sense of what's happening and to make more sense of how you can make better strategic decisions in your own investment portfolio based on your goals for where you're looking to accomplish or what you're looking to accomplish and where you're looking to go and where you're looking to take things. That's how we back into it. This is one of the points of leverage. It's information, it's insight, and it's decision-making fodder. So I hope that today was valuable for you. I want to encourage you to share this episode with a friend. Go ahead and have a discussion with someone else. We have to have discourse, especially in uncharted territory in terms of the economic times that we're in currently. And of course, we're always in a historic environment, but it almost feels like currently is a little bit more historic than normal. And so I definitely want to encourage you to have a discussion with one person or maybe even invite a group together to utilize this discussion as your case study and dissect various parts of what we've talked about, whether it's interest rates, whether it's debt market, whether it's equity, whether it's yield compression, whether it's supply chain. One of the things we didn't talk about was construction costs and where are those things going, geopolitical moves and how that impacts yields in the United States and otherwise, and how that impacts other sort of domino effects in the marketplace from other countries and so forth. And so, having a discussion about that, I think is critical. Putting action steps in place, creating rules, being willing to be adaptive and nimble and pivoting based on trends. And so having a discussion on that, I think, is a big separator and one of the ways that high performing real estate investors become even higher performing and can outlast, sort of the competition and can be successful in the long term. Because really that's what it's all about. It's about long-term success. And that's what we're about here on Elevate. So I want to encourage you to identify not only sort of the opportunity to discuss, but your top 3 takeaways. What are your top 3 distinctions? And also, of course, most importantly, what's the one thing that you're going to take massive action on immediately? Maybe you're going to put something in your calendar. Maybe you're going to journal about something. Maybe you're going to do some more research on a certain topic or part of the discussion from today. I want to encourage you to make time and make a commitment to take massive action. And so thankful to have the opportunity of bringing this conversation to you. So thank you again for listening. And until next time, Elevate Nation, we will see you next time.
Thank you for listening to Elevate. If you enjoyed this episode, be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, take this opportunity to elevate your results by taking immediate action on what you learned. For more, visit elevatepod.com.